All right, guys, so today we are going to talk about the obvious, right? We are seeing a shift in our real estate market. And so what are kind of the things that we are seeing out there, and what are we forecasted to see happen throughout the remainder of the year? So I've kind of put some stuff together that is more factual versus opinionated, and then I'm going to also give you my opinion. Because we're out there every day, we've been feeling this shift for probably, what do you guys think, the last month or two?
Yeah.
The biggest change has really been in the last 3 weeks, I would say, right?
Yes.
And then Lisa Wells from Cross Country Mortgage, she is an amazing loan officer. She does a ton of business because she knows her stuff. She's always in the know. That's what we're going to call these trainings, in the know, so that you guys can educate your clients on what is happening, so that you can kind of put their questions and fears at ease, right? Always be the professional. Okay, so my buddy Parker had shared this, and this is from a top Zillow economist. Macro outlook. We are seeing early signs of softening housing demand, driven largely by the fast deterioration of home affordability following spiking of interest rates. Meanwhile, inventory has been recovering faster than we previously expected. Okay, so they're seeing a shift in demand. Inventory is increasing a little bit, much faster than what they expected. These market conditions combine to add downward pressure on the ZHVI, which is a Zillow index for the housing market, growth rate. Although we don't expect home prices to decline across the country in the near term, the next 3 months, there is still a significant imbalance between housing demand and supply. Okay, so we're still seeing shortage of supply. The demand is changing a little bit because of the interest rates. Not all buyers can afford what they could have afforded 6 months ago, 3 months ago maybe, when they were pre-approved, right? So those numbers changed. So the Federal Reserve's, hold on, my little thing is in front of the Federal Reserve's rate hike plan and labor market conditions require close monitoring. Current labor market conditions are still strong, but aggressive interest rate hikes may bring significant uncertainty to the job market in the near future. The job market is huge for us, right? A deteriorating job market would add significant downward pressure on housing demand and downside risk to home prices. We must remember that the unemployment rate is a lagging indicator. Following the latest inflation report, the Fed is signaling intentions to raise interest rates more aggressively than previously anticipated. Okay, so we're still going to see a few more jumps. Lisa will I'm going to interview Lisa after this, ask her some questions that our buyers want to know, and she'll kind of answer those for us in a bit. This signaling from the Fed, along with continued record high inflation, stock market slide, and layoffs or hiring freezes at several large tech companies, is negatively affecting consumer sentiment. This is likely to contribute to a weakening housing market. Okay, so right there, the Zillow economists are telling us all of these things that we're starting to see will continue bringing a shift. So what does that shift look like, right? Is it going to be a housing crash? Is it not, right? We are closely monitoring all of the above indicators to capture potentially early signs of a weaker than currently expected housing market. Okay? So now they're seeing a softening in housing demand. The Fed's going to watch this, what's happening with the stock market, what's happening with the, with jobs and employment and all that kind of stuff. All of these things are huge indicators into what we are going to see throughout the remainder of the year. Now, Zillow is on a national scale, right? So let's kind of dive in deeper to just our Minneapolis housing market here and see what they're forecasting. The Housing Affordability Index reacted to higher prices and rates with a reading of 94. And you guys need to understand what this means, okay? So this is the Affordability Index at a 94. Meaning the median income was 94% of the necessary income needed to qualify for the median priced home under current interest rates. Okay? Given more listings and fewer sales, a loosening in inventory could cap price gains. So demand goes down a little bit, inventory's increasing a little bit, that could cap how much sales price is going to continue to increase, right? But it takes, a loosening inventory could cap price gains, but that takes time to play out, and prices are unlikely to soften in the short term. Short term's 3 months. Meanwhile, the Metro sits at 1.3 months supply of inventory, 18.2% more than last year. Okay, so when people ask you, what's the supply of housing right now? 1.3 months supply of inventory, up 18% more than the year prior. A balanced market has 4 to 6 months supply. So right now we're at 1.3 months supply. A balanced market is 4 to 6 months. So we are still far from being caught up on our lack of inventory, okay? There's a sense out there that things are rebalancing somewhat. So what is the shift? We are shifting towards a balanced market, not a crash. That's what Zillow's forecasting. That's what our Minneapolis Realtor Association is forecasting. So all of these people that study every single indicator out there, they are forecasting more inventory, a little less demand because of interest rates, and more of a balanced market. They say also, Denise Mazzone, but it's important to remember that we have a long way to go before we're in oversupply territory, so prices should remain firm for now. So that's huge to educate your clients on, right? Month supply, 1.3, balanced market is 4. We still have a long way to go. Home prices are still increasing. Demand has gone down a little bit due to affordability with interest rates. It's as simple as that. Okay, so now this is another thing from our Minneapolis Realtor Association. There were 6,766 homes on the market at the end of May, 5.3% more than May of 2021. So more homes on the market. Median sales price reached a record of $375,000, up 9% from last May. So when you're going to talk to people about selling their home, you can tell them right here, we're at record sales price right now. So people that are going, gosh, Megan, I really wish I would have sold last year. Why? We're up 9% from last year.
Now you have all the comps too.
Right? That's exactly what I was gonna say. You have the comparable properties that have sold to justify that sales price with less of a need to have that appraisal gap coverage, right? Pending sales were down 11.8% from last year's May peak. Now, that sounds scary to sellers, right? Pending sales are down 11.8%, but what we need to realize is those properties that are not going under contract are because they're overpriced, and we need to educate our sellers on that. It's not because there's not the demand and the inventory has leveled out, right? There's still the demand, we're still in a shortage of inventory. Your house is overpriced if it's not selling. If you're not going to pending, the average days on market right now is 7 in Twin Cities area. If you're not going pending in 7 days, your property is overpriced. That's what the housing market is telling you. According to new data from Minneapolis area realtors and the St. Paul Area Association of Realtors, the Twin Cities metro area ended the month of May with 6,797 homes, 5.3% more than last May. This is the first year-over-year inventory increase since March of 2020. This is the first month year-over-year that we have seen an increase, okay? So that's a shift.
That's in May.
That's in May. Okay, Mark Mason, president of the St. Paul Area Association of Realtors. Listings are still selling quickly, even with record high prices and higher rates. Even with record prices and higher rates. So when you're educating somebody, if someone says, I'm thinking about selling my home, this is exactly what you can tell them. From the Association of Realtors, listings are still selling quickly, even with record prices and higher rates. Half of all homes went under contract in under 7 days, which is even with the year prior. So we're still seeing them sell just as fast. It was the same as last year as far as how quickly things are selling, right? So that little tiny decrease in demand has not affected us yet if properties are priced properly. Okay, that's the ticker. The good news for sellers is that despite a cooling in demand, buyers offered 4.1% over list price on average, a small increase compared to last May. Okay, you guys, so now we've seen a 9% increase in sales price since last year, and we're seeing an even larger percent increase over asking on listings. That is huge to educate your sellers on. Would we all agree that right now is a better time to sell than last May? Sales price is up, what people are offering over asking is up. It doesn't matter if half the buyers are cut out, right? They're still getting over asking, they're still getting more. So that's huge, okay? Oh, my computer's dying. Okay, recap. Sales price is still increasing and is not forecasted to go down anytime soon. Okay, so that's something that we know. We have this factual knowledge here from these people that literally study every single determining factor of what's happening in our marketplace. We still have a lack of inventory, even with inventory levels climbing. We're seeing fewer offers and showings in our listing because the buyer demand and affordability has shifted, right? Properties are still selling on average for 4% over list price in multiple offers in under 7 days on the market. Fewer properties are pending, which only means pricing it right matters even more with affordability changing due to interest rate hikes. Okay, so before, when properties were overpriced, what did you think was happening? Buyers didn't care. They had a 3% interest rate. They could afford it. They thought, I'll go with that house. Who cares? I love it. Now, buyers are really paying attention to what they're spending, right? They're looking at the home that's overpriced and they're going, gosh, I just can't do it. I could have done it last May, but I can't now. But properties that are priced properly are selling, okay? What to tell your clients? Buyers, buy now. With less competition and both interest rate hikes and sales price on the rise, it's better to buy now and refinance later. Start building that equity and don't wait on the sidelines. Homes are only going to become more expensive and rates are not forecasted to go down at least anytime soon. So buyers, tell them buy now. We have all the facts, right? Interest rates are on the rise, sales prices on the rise. Get in and start building that equity, and that's really what you need to educate them on. Why would I buy now instead of wait for rates to go down? Well, now you've just lost possibly 2 years of equity that you could have been building. Remember, the best thing to tell someone that's renting is your interest rate on rent is 100%. Sit with that. Rates are at what are they at right now, Lisa? 6?
High fives.
Okay, high fives.
Low 6.
So you're worried about a high 5 interest rate when you're paying 100% if you're renting. That is something that really needs to resonate with people. We need to be the ones educating them on that, right? Sellers, okay, what to tell your clients? Sellers, sales prices are at record highs. Homes are still selling in multiple offers for over asking. We are just seeing fewer buyers and fewer offers, but not under asking. In fact, on average, 4% over in under 7 days on the market. 5 offers versus 15 with a higher sales price compared to last year. Bonus, we now have all of the comparable properties that sold last year to use for the increased sales price and appraised value. Okay, so we are headed toward a balanced market. What does that mean for realtors and what do you need to do? It is going to get much more difficult to sell homes. Okay, for those of you that are newer in this industry, the last 2 years have been gravy. It is not going to be like that. What is your plan? You need to have a plan. How are you touching your sphere of influence regularly? Are you the real estate expert? Are you providing the knowledge instead of them going to the news, right? Those things are so important. Touching your sphere of influence, touching your past clients, right? Being in front of people is going to be more important now than it has been the last 5 years. And it's all about knowing your market, studying what the experts are saying, knowing what the economists are forecasting. You have to be the expert and you have to get it out there. Your social media is going to be huge this next year, right? Posting something all the time, showing that you're the market expert. Gosh, Jerry, I just watched that video. That's awesome. I'm so glad that you shared that with me. This is a wealth of knowledge. You guys should absolutely take what you've learned from this presentation today and put that on social media. Because these are the facts. It's not my opinion. My opinion is what the facts are. Yes, we're seeing a shift. Yes, it is going to get a little more challenging to sell homes for whatever people want for them. And that type of a market could not last forever, right? So we need to get serious about our prospecting. We need to have a plan on how to touch our sphere of influence in our social media. Those are the two biggest things that you can do, okay? Weekly touches social media every day. You should have at least 3 posts to your story every single day on social media. Regardless if it's you doing a showing, you doing this, you doing that, but have something educational, market related once a week to really stay in front of them and be that professional. Now, where can you go to get this type of information? How do you find out, where do I go to get this information, Megan? How do I know what the economists are always saying? MinneapolisRealtor.com is a fantastic place to go. It is a wealth of knowledge. They do a summary market report every single month. You can read that. That's what I read every single month, so that I'm up to speed on what they're seeing, because they're doing all of it, the entire Twin Cities area, right? So, any questions on that before I turn it over to questions for Lisa? Do you guys feel good about that? Kind of good news, right? Okay, Lisa.
You want me to come over there?
Yeah,
Okay.
you need to be on video.
I
Okay,
don't know if we both.
so let's do
I think you're okay.
let's do the very first question that everybody wants to know, right? Are rates forecasted to go down anytime soon, Lisa?
No, not
Okay.
anytime soon.
Okay. And when we qualify soon, what does that mean in a loan officer's perspective? This year, the next
I don't
month?
know. I would say 3 months
Okay.
is soon.
Yeah, that's what it is for real estate too, right? So whenever an economist talks about a short-term forecast, that's a 3-month window of time. Okay, so within the next 3 months,
No.
interest rates are not going down. What are we seeing right now for interest rates? High fives?
High 5s, low 6s. So I preface that with, we can get you whatever rate you want for a price. It's just how much do you want to pay? And I've seen outrageous amounts of points being paid by consumers, which I think is an epic error right now.
Yeah, like
Yeah.
why?
Why?
Yeah.
Because people get stuck on a payment and they have no concept of what it costs to get there. So right now, if I truly think that we're gonna go through a recession, which we probably will, my opinion, we probably will. In a recession, in general, interest rates come back down. So technically, we probably are in a recession right now. The data's just not out. And so with that being said, in a recession, once you hit a recession, it's usually between 12 and 18 months before you start to see interest rates come down, because it takes that long for kind of the economy to work through and go, holy cow, we've got to make some adjustments to speed it back up again. And so if that's the case, and I think that we'll see better interest rates at that time. Usually the average is if you're about 1 point to 1.5 to 2 points off the high end. So if 6.5 is our high end, we probably are going to see something 5.5 to 4.5. Well, if I'm putting people in a mortgage at 30 years at 6.25, and I see high 4s, they're going to refinance. However, if they've paid 2, 3, 4 points, that is money out the window, which is why I wouldn't be paying a whole lot of points right now, because I think that's the future.
Yeah.
So do the people who are so like on these points, do they think it's not gonna change, or what is their reasoning?
So right now, I think the biggest challenge that we have is consumers have sticker shock, right? We have clients that were approved in February and March, and interest rates were 4%, and now we're showing them 6%. And we've done our best to say, here's an update, here's what's going on, but just some people don't see it, don't get it, don't understand it. And so I've mostly seen it from online lenders. It's their way to make them look like a lower interest rate. And so consumers think that at the end of the day, that's the only way that they can make their payment affordable for them. But at the end of the day, you have to deal with it now and be okay with the payment now, and know that down the road you can take advantage of that interest rate coming back down. And there is, I always use myself as an example because I think I am John Q. Public, but I've owned 4 homes in my lifetime, And the longest one I ever was in was 7 years, and I refinanced, 7 years, and I refinanced it twice. So it bothers me when people get advice to buy their mortgage rates down for 30 years, when right now at this interest rate, it's very unlikely you're gonna have this mortgage for 30 years, not to mention 5.
It's almost, I feel like 30 years is like almost impossible. That's
Almost
like-
impossible.
Yeah, for that to actually happen.
Mhm.
Yeah.
Yeah, so that's why I just think we see a lot of that, and it's not something that I would recommend. Now, there are things right now that we are doing that I think is a good plan, and it's a 2-1 buy down. And what that means is the consumer is basically, and not really the consumer, it's us, it's the seller, it's the consumer, whoever can participate, because it's not cheap to do it, but it has the most bang for your buck. So I'll give you just a really quick example, is that
Yep,
okay?
and I was educating them a little bit on this because I said she has an amazing program for people that do have severe sticker shock and they can't really think past it long term, right? This is what I want you guys to know, because this is going to be huge for
Well, I think
buyers right now.
This is where, this I think gives the most bang for the buck. One, you're buying the interest rate down for 2 years, not for 30. And if we truly think that we'll probably be refinancing people in a couple of years, they're not wasting a bunch of money. So I'll give you this example of consumers. So we had clients that were looking at a house for $650, and they were gonna go in at $637. And rather than going in at $637, I said, go in at $650 and have the seller contribute to some closing costs for you. Because that way I can not only use it for closing costs, but I can use it to buy your interest rate down. So basically, if I showed them a 5.99 for 30 years, the first year their monthly payment would be based on a 3.99,
Okay.
okay? 12 months, 3.99. Second year, 4.99.
Okay.
And only the third year and forever until they refinance it, get rid of it, do whatever, would be that 5.99. So in that first year, the monthly payment difference, $716 a month difference from the 5.99 to the 3.99. Every single month, like that's real money. Second year, $407
Oh my
a
gosh.
month. And then you go to the third year. But that I think is the best way, because it alleviates the sticker shock. People get in, they get used to the payment, and then maybe we're refinancing in 3 years and we can actually get them those rates so their payments don't go up a lot.
Yeah.
So for me, sorry, my voice is very allergies.
No, you're fine.
So for me, I think that is a great way for people to then kind of get in, bridge the gap of that, oh my gosh, my payment is way more than I thought.
So what is the difference between buying down on the 2 years versus the 30? It's much less expensive, or I guess what's the biggest, like how would I
It's
explain
actually a
that to
little more
client?
expensive.
It's more expensive, but
But
what
here's,
makes it like smarter?
because you're buying it down and it has way more impact. So if
I get it.
have,
Okay.
if I buy my mortgage rate down for 30 years, so let's just say I buy it down from 5.99 to like 5.6. And I did these numbers, so I'm not just blowing them out of control. 5.9 to 5.6, that will typically cost you about 1% of your loan, but it'll only save you about $72 a month. And it'll save you for 30 years.
I see.
So your savings is stretched out, where now we're basically condensing that's it and giving you way more impact, which is really what people need right now.
And it's way better than an ARM, because an ARM would fluctuate on year 3 or 4.
Well, and I don't even, I think ARMs are fine, but right now, because in general, because when the government raises the federal funds rate, like that's what they've been raising, so that is the direct cost of what banks trade money at. So anyone that's got an ARM that is fractionally decent, and I mean fractionally meaning maybe it's a quarter to 3, it's better than a 30-year fixed, those are gonna typically be banks that are just holding those. Like us, our ARM rates are not great and not aggressive, and the reason is, is because the market thinks that the interest rates are probably going to be refinanced in the next few years.
Got it.
And so they don't wanna give you a great deal on an ARM knowing that its
It's a great deal
maturity is
later.
short.
Yeah.
So they're not gonna get their money's worth, does that make sense? So that's why the arm rates in general, for most people like us, are going to not be really great.
Okay,
And you might have some outliers that have good arm rates, but you get one more pop from the Fed and they won't be great anymore, in my opinion.
so how much more expensive is it to do is it 2-1 buy down?
Yeah, so the 2-1 buy down. So if you pay a 1% origination fee to buy the interest rate down a quarter, if you want to do a 2-1 buy down, it will depend a little bit on the loan amount,
Okay.
but in general, it's going to cost 1.75 to 2%. So it's more expensive. However, this is where the seller can contribute some, if you can get that. The lender can contribute some. The buyer can contribute. So if the buyer's willing to pay 1% origination, okay, that's almost half of it.
Right.
So then, do we contribute? Does the seller contribute? So there's lots of ways to do it, but I think the impact is so much more than buying it down and saving $70.
Yeah. No, that's really good
I
to
saw
know.
that on a listing this past weekend that said seller will contribute a buy down to the buyer. Like they're saying the market
Yeah,
is-
and I think right now too, like, you talked about, listings and all of those kind of things, and yes, some demand is waning a little bit, but I also think right now is a great time for all those people that had, maybe could use a little bit of seller concession, and maybe could use a little bit more
Yeah.
time to just think things through.
Yeah, for sure.
This isn't a great time for those people to come back into this market.
Yep.
I had a first time buyer the other day with down payment assistance, and he was like, man, I really blew it on not buying when rates were 2 or 3%. I said, actually, you didn't.
Yeah, because you wouldn't have gotten your offer accepted.
You weren't really
You weren't
a
competitive.
buyer.
Yeah.
And no one was gonna accept, you don't have
Down
any
payment assistance.
down payment, you
Yeah.
don't have any appraisal gap, you don't have
Right.
a whole lot of skin in the game. You are just a little bit more tight right now. So right now is really your window. This is your time. Because you have the ability to probably have some people consider you because they've been sitting a little bit longer. Maybe you can pay a little bit more and they'll consider your offer versus something else.
Yep.
But when the interest rates were 3 and 4, you weren't really a buyer. No, why would they take your offer when they had 13 offers and they were all over list and they were conventional with appraisal gap to God only knows who.
Yeah.
So now is that time
Yeah.
for those people to jump back in this market, for the FHA buyers, for the VA buyers,
Yeah.
to get back in this market because you have the opportunity, and this window will not be open for a super long time. So when interest rates do start coming back down, if they do start to hit the 4s, all the people that went on the sidelines will come back into this market,
Totally.
and it'll push that frenzy again. So this is, I think, that window of time for those people that were edgy. Now's their time to kind of
Do you think it'll
get back
any
in.
better for like contingent buyers?
Yes. So one thing, do I have my
Like contingent
Oh,
sales
yeah,
of
we
the
have my
home
phone.
and that kind
And
of
I,
thing.
only because I think this is important, because I was just asking our team. So in the last 2 weeks, we took in 13 contracts. So in the last 2 weeks, 13 contracts. Out of that, we had 1 contingent offer. We had 4 that were at list price. We had 3 that had seller concessions, and only 4 of them had appraisal gaps.
Yeah.
So right there, that is telling you, and for me, I do this, like, I feel like I'm the best market analysis I have, because that's what we're
Getting
seeing.
the actually
We're getting
accepted
it.
offers. Yeah.
Yes.
Right.
And so out of those, kind of what's happening, we're definitely starting to see not crazy offers over. And if we are seeing some over, they could just be in a hot pocket or
Yeah.
price point,
Or a really great house.
really great house, or they're doing over and then they're getting seller pays, or they're getting money to do the buy down and things like that. So
We're getting an inspection.
yes,
started to notice that.
inspections
We just
more.
Yep,
accepted
I finally just had
one.
another inspection yesterday and I haven't had an inspection.
And I went tonight.
Yeah.
Yeah.
And we had, in
Yeah.
fact, I was just texting with a client the other day who kind of went on the sidelines, and they said they would not buy if they could not have an inspection.
Yeah.
So now they're thinking, hey, should we come back in?
Yeah.
Because now,
Is it
yes,
safe? Yeah.
this is your window.
Yeah.
So
Yeah, yeah.
Yeah.
Blame them for not
Mhm.
wanting the
Totally.
inspection.
Yeah.
I know.
So I do think right now it is, I think, a really good time to buy in spite of the interest rates, because
Yeah.
there are other factors that people go forward with. And every time I talk to a client, it's like, why did you pick now? Why now versus when the rates were 3?
Right.
Our budget says we're ready,
Mhm.
we're mentally ready. People do not buy homes for roof and shelter simply only because interest rates are low.
Absolutely.
They
and
buy-
they need to buy a house.
Because, yes.
Lifestyle factors, right? It doesn't all revolve around interest rates. And the
Yes.
realtors that will not survive this shift are the ones that believe that
Yeah.
and quit and give up. The market's hard, the market's crashing. Guess what, you guys? It's not. We're seeing a shift. There's opportunity in every single shift in the real estate market. There always will be. And you just have to be in front of it because of your education, because of talking to people. This is why I love Lisa, because any single client that is on kind of like the, I don't know, like blah, 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 I'm like, reach out to Lisa, just have a phone call conversation with her.
Mm-hmm.
I'm not kidding you guys. She converts 98% of my clients.
And I'm not a salesy person.
No,
I
it's
truly
the
am
facts.
not.
It's just
I
knowledge.
you
know,
but
it really
this is what I
is.
believe.
Yeah.
And if I had a nephew, a neighbor, my niece is buying right now in North Carolina, and she's like, I don't know if we should buy it. I'm like, hell yes,
Just do it.
heck yes, you should buy. And here's why. And it's because that's what I believe. But the other thing I believe is because housing is one of the best investments. So I always go over this with clients, and you can't really see this, but return on your investment. Real estate is bar none one of the best returns on your investment. So I have a little graph here that shows like when people do their down payment, on average, that down payment in 5 years will return 50% year over year. If you do a 401k, it's much less.
Wait, say that stat one more time because that is huge.
So when you, and again, it depends on how much you're putting down. If you put less down, but again, when you look at how housing appreciates
Yep.
and how much you invested versus the rate of return of your money, 50% on average year over year,
That's
which
insane.
is insane. A 401k, nothing returns like that.
Mm-hmm.
So, and again, it matters how much you're putting down. If you put 20% down, it's actually a little bit less return. So the less money that you put down, the more return, because your house is going to appreciate regardless of what you put down. So that's kind of sometimes what people miss
For sure.
on that. But I just think in general, you're buying because it's roof over your head, but you're also buying because this is the long game a lot of times on real estate. And the longer you have it, the better investment it is.
Yeah.
I mean, homeowners are 80% more wealthy than any renter because of that.
It's huge. What else was I just going to ask you? Something that was just on the tip of my tongue. I don't remember. Okay. This was all really good knowledge. I feel really good about that. Oh, the down payment thing.
Yes.
So, how many buyers have come to you and they've said, even my friends say this to me, Meg, I don't have 20% down. You just heard it. That
I don't
little
think you
set,
should
right?
put 20%
No.
down.
Exactly.
No.
So it's not even really smart to do that. Why don't you allocate some of that money into a 2-1 buy down, right? Put a little less down. There's so many different things that you can do instead of just putting 20% down. Like Lisa said, are you going to be there for 30 years? Probably not. You're probably going to move. What's the average homeowner? 5 to 7 years?
Yeah.
And then they move again?
Unless
So
you're
it's
a
like-
parents' generation and you bought in the 80s. Then
Totally.
You might be living there for 30 years.
Yeah,
Some of
That's a
them
different
did.
world. That's a
Yeah.
different world. Yeah.
Yeah.
And those people are even catching on, right?
Totally.
Like,
Put the money
I
somewhere
should really
else.
put the money
Wow.
somewhere else. Yeah. And it's all about educating. So the more videos you do, the more information you put out there, the more conversations you have with people like Lisa, the better off you're going to be for your clients in today's market. They just need to know. They're nervous, they don't know, they watch the news.
They watch the news.
Okay.
Yes.
My whole job is to combat the
That-
news.
For
Yeah.
Sure.
Yeah.
That's
And
my
I think
goal,
just
too.
to piggyback on that, this is something that I say all the time to clients when they're asking me, they're like, I want to put 20% down, or, you know, and I'm like, that's amazing, that's great. I will always show them less money down because at the end of the day, you can learn from my wisdom. I've done this for 22 years at this point. It's all I've ever done. And I have lived through the dot-com bubble, I've lived through 9/11, I've lived through the mortgage meltdown, I have lived through COVID and whatever else that they're going to come up with.
Yeah.
But one thing that I know is true, the less you need me to access your equity or your money, the better you will be. So in the early 2000s, when the economy was great, everything's great, so many people came to me, refinanced, wanting to do a 15, let's get it paid off. And then guess what happens?
Yeah.
2008 starts to happen. All of a sudden, those very same people, their spouse is laid off, they rack up credit card debt, and then they come to me and they say, Lisa, we don't want that 15-year anymore. We need cash flow. We need to extend it to a 30-year. And guess what I say?
You can't.
No. Your credit stinks. Your debt rate's just too high. So again, the more that you don't need my permission to get at your equity, and that's what you're doing, because the only way you get your home's equity is by selling or getting a loan, the better you will be.
Well, and if you don't put 20, say you have a buyer that's got enough for 30-40% down. Like I have a buyer who's got a ton of cash and they
Yeah.
want to put as much down, but I'm also like, if you put 20, even if you put 10% down on your house, you can take that other 30% and buy another property.
Buy
And then
another
you're
property
never-
or
you're
put it
never
in the market.
like- You're
But-
spending even more, and then when your properties appreciate and you sell, you're still better off in the end game. So it's like
We have a lot of clients that are second and third buyers that are cash poor and equity rich.
Mm.
So what happens in a really crazy market with those kind of clients?
Yeah, they always.
Very challenging for them because they need their equity in order to put a decent down payment.
Right.
Because they don't, everything's in their house, they've been bang, which is great. But there's lots of tools that when we're talking to clients, we will show you, okay, you can do this, but let's just say conservatively, I take this over here and put it in the market or put it somewhere conservative. I know the stock market's down a ton, but I get it. But everything's on sale right now, 30% sale. So if you look at it that way, put that money in, I guarantee you that money is way better spent over there than paying down a mortgage.
Totally.
But we have all of those things, so when I'm showing consumers, at the end of the day, I don't care what you do. Whatever works best for you, my job is to make sure you understand what your options are
Yeah.
and what they look like
Yep.
so that it doesn't fit you today, but it fits you tomorrow and next week for whatever else you might be thinking or wanting.
Yeah. Do you guys have any questions?
I feel
All
like all
s-
I would, or you go.
Go ahead.
I feel like all I would want is like if you have any like real examples, or if you can make like a quick one of like comparing the buy down versus people that are doing the points.
I have it.
Okay, because I need that to like.
It's a visual, and
Yes.
I actually did bring a flyer that we created. It's just like we're not artistic, so we'll shift it around a little bit, but the data is there, and I think that's what will go, oh, wow, okay. Yeah, so we'll work on that. We're gonna do some social posts on it, because I just feel like
Mhm.
it's kind of the,
Now, is that a
Dark
conventional
horse.
loan or a?
yeah, so let
It
me,
is, okay.
yeah, it's conventional only
Only,
right now,
okay.
so no government, no VA, no USDA, no jumbo, no ARM.
Okay.
So it's fairly limited.
Yeah. So it's for a very conventional buyer.
It is a very conventional buyer. I'm not saying that it won't come out, it's definitely has been in the past available on government stuff, just not at the moment.
Okay.
And then just to confirm the 2-to-1 buy down, so it does go up after that 2-year time frame, but then theoretically
that's
you
the
can
current
decide if
rate.
you wanna.
Yep, that's the current rate. So really right now, if you were gonna buy and you didn't do a buy down, you could get like 5.99. So that's the current rate.
Yeah.
The only caveat is we're adding kind of like an extra dish onto your entree saying, but for 2 years, you can have this payment and this payment, which will save you gazillions on your monthly. But then on the 3rd year, that's where you would have been if you didn't do the 2-1 buy down.
So it still is at the current rate, but it's not like 2 years from now, whatever that rate is.
Nothing's,
Okay.
nothing's gonna move.
Okay.
Nothing's gonna move. You are locking on a 30-year mortgage at whatever you're choosing to lock at. It's
You
just for
get
the
a
first
discount
2
for the first
years.
2 years.
Right.
Correct.
Well, if you think about buyers who are probably in like the prime of their career, they're growing, like
Yeah, for sure.
theoretically year over year, they're gonna be making more money. It might not be the best option for people who are like on a fixed income or something like that. I mean, it could be, yes, but like
Still could be,
Yeah,
because
I mean,
if I truly
rates
think
are lower.
that in a couple of years we'll have better interest rates.
Yeah.
The beauty of this program, in my opinion, is that it kind of bridges the gap,
Mm-hmm.
because I think by the time year 3 happens, we'll probably be refinancing the majority of people. And here's the other thing, this money isn't lost. So if we refinance you, and let's say we refinance you in a year because interest rates drop, and you still have a chunk of that money that you would use for the buy down, one, we'll give it back to you. Or we'll reduce your loan amount, or we'll put it towards the cost of the refinance. That's the beauty of this, it's not lost.
That's super cool.
Is it a initial like upfront chunk that they pay for the
And
whole?
like, closing
if you
years?
think about it, like if you've got seller paid closing costs,
Yeah.
like instead of some of those going towards that, then a chunk goes into an escrow account, and that's kind of what funds, because really your payment's your payment. It's just we're funding it for you, or with that escrow account.
So it's like it's happening, and there's this chunk that goes towards it, and it's
Mhm.
3 years, and then they could refinance
Absolutely.
sometime during that, and then
Yeah.
if that chunk has something to be given back, it'll be
Yeah.
given back.
Yeah, so like think about it as like a normal escrow. Like if you have taxes or insurance in your mortgage, and let's say you decide to switch insurance companies, but you have an escrow account with like, $800 from that previous, policy, that would either get refunded to you or come back. Same thing here.
Mhm.
I don't know if that was the best example, but it's all it came up with.
Yes, that was good.
Mhm.
I think this is really good info. For
And
sure.
people don't know it, and it's confusing.
But it's only through Cross Country Mortgage, right?
Mhm.
Yep. So it's lender specific for
Yeah, not
as,
every
as far as a
lender.
program that
Mhm.
Lisa has to offer for clients. And I think it's a fantastic option, and it would be a great touch to reach out to any buyers that you have set up on a search or have had conversations with within the last year that have not bought a house yet. You need to reach out to them and tell them about this as if it's the latest and greatest opportunity, because it is.
Well, and any
So-
client that's, just went on the sidelines because it was just too crazy. They couldn't make decisions in 30 seconds. They didn't feel comfortable overpaying or paying, over list price. Any one of those people for us, that's all we're calling right now, is talking to them about get back in the game. Now might be your window. This is the time where you can make some
Headway.
headway and just have a second to breathe and decide versus, oh my god, some people
Yeah.
just don't function well in that world.
Yeah. And it was tough. You had 30 minutes, sometimes 15 minutes to see a home, and
Yeah.
you were booted out with zero
And this
inspection.
is a big investment to
Yeah.
make those, and those people that made those decisions and won in those options were amazing because they were rewarded with that interest rate. Now
Absolutely.
people
Yeah.
are going to be rewarded
Right.
with this market. I think
Yes.
every single market has opportunity. You just got to know where to find it and know what person wins now.
Yeah.
You know?
Sure. Yeah, I feel like there's always gonna be something good and something bad, and it's
Always.
like just
If
do
you-
it when you want to.
Right.
Yeah.
There's always gonna be something.
Yep.
Oh, exactly. I always tell if I have consumers that are buying and selling, I'm like, you're never gonna win on both sides.
Yeah.
Impossible. You're always gonna give a little bit. So all those people that were selling and buying, they won a little bit on the sale.
Exactly.
They paid a little
Yeah.
bit
You
on
had
the
to give it
buy.
more on the buy side.
So
Totally.
pick your poison,
Yeah.
Yes.
because there's always gonna be something.
And just
Yeah.
get over it.
Yeah.
Yeah.
You're not gonna win it all, you're not gonna
Yeah.
get that sale at
Exactly.
every certain- And if you do, great, but like
That's pretty
probability-wise,
unlikely.
yeah.
Right. Awesome. Any more questions, guys? Thanks for tuning in.